Welcome back to the deep dive. This one is especially for you, our listeners, in grade 9 and year 10. If you're starting to think about IGCSE subject choices for next year.
It is a big decision, yeah. And we thought it'd be useful to give you a real feel for the IGCSE Business Eat Excel course. We're going to zoom in on one of the core units today.
Absolutely. Today, it's all about business finance. We're digging into the actual Eat Excel course material to sort of unpack what makes it tick. Our mission really is to show you why it's so important, maybe make some of the ideas that seem a bit complex feel a bit more straightforward.
And just show why getting your head around business finance isn't just for accountants,
Yeah.
It's kind of like a superpower in the real world.
Totally agree. Think of it like getting a backstage pass, seeing how businesses really work financially, why some fly and others, well, don't.
Yeah, understanding that flow of money is crucial.
Okay, then, let's get into it. So let's start right at the beginning. Every single business, whether it's tiny or massive, needs money. But, where does it actually come from?
Right. Finance, that's the business term for money. It's like the oxygen for a company. They need it for all sorts of reasons.
Like what?
Well, just to get the doors open in the first place. Then there's keeping things running day to day, paying the bills, and, really importantly, to grow, to expand, maybe develop new things.
Okay, so different needs. Does that mean different kinds of finance?
Exactly. We usually split it into short-term and long-term needs.
Yeah.
Short-term finance is for the everyday stuff, the operational things.
Like paying wages or suppliers.
Precisely. Paying salaries, buying materials, covering the electricity bill. It's money you need fairly quickly, and usually it gets paid back within, say, a year.
Right, keeping the lights on, basically.
Yeah. Then you've got long-term finance. That's for the big-ticket items, things that last.
Buying buildings, big machinery.
Or funding a major expansion project. These are investments that will pay off over many years, so the finance is structured to be paid back over a much longer time, too.
Got it. Short term, long term. Now, the sources, you said internal and external, from inside or outside the business.
Let's start with internal money generated from within the business itself. For a brand new business, the most obvious one is often personal savings.
The owner putting their own cash in.
Yeah, like the example of Maurice Obuya in Kenya, using KES, $2 million of his own savings to start his taxi firm.
That's a brave move, but I guess it's cheap finance. No bank interest.
That's the big advantage. If you have the savings, it's right there. And no interest payments, no loan conditions from someone else. Another key internal source is retained profit.
So if the business is already running and making profit,
the owners can choose to leave some of that profit in the business rather than taking it all out. They reinvest it.
Again, sounds cheap and flexible.
It is. Very useful. And finally, internally, businesses can sometimes raise cash by selling assets they no longer need.
Like an old van or some unused equipment.
Exactly. Turn something sitting idle into useful cash.
Okay, so savings, profits, selling old stuff, those are internal. What about getting money from outside? External sources.
Right, and there's quite a range here. Banks are the traditional go-to. A common short-term option is a bank overdraft.
That's where the bank lets you spend a bit more than you actually have in your account, up to a limit.
Yeah, it's a safety net for temporary cash flow hiccups. But you pay interest on whatever you use, of course.
It makes sense. And loans.
Loan capital is a big one. Borrowing a fixed sum from a bank or another lender could be short-term, maybe for buying stock, or long-term, like for that machinery we mentioned.
And you pay it back in chunks with interest added on.
Usually, yes. Regular installments plus interest. Remember Maurice Obuya? He used a bank loan as well as his savings.
And loans can be secured or unsecured. What's that about?
Good point. A secured loan means the business offers an asset, like its building, as security. If they can't repay, the bank can take the asset.
Ouch. But less risky for the bank, so maybe lower interest.
Generally, yes. An unsecured loan doesn't have that specific backing. It's riskier for the lender, so they usually charge a higher interest rate. And a mortgage is just a specific type of long-term loan, always secured against property.
Okay, banks offer quite a bit. Any other external places businesses get cash?
Oh, yeah. A really common one, almost invisible sometimes, is trade payables or trade credit.
That sounds complicated.
It's actually simple. It's when your suppliers let you have goods or services now, but pay them in, say, 30 or 60 days.
Ah, so they give you a bit of breathing room, like a free short-term loan from the supplier.
That's a perfect way to think about it. Helps manage cash day to day. Then you've got things like credit cards, convenient for small, flexible spending.
Sure.
And hire purchase for assets like vehicles. You pay over time in installments, use the asset, but only own it right at the end.
What about bigger companies? They need serious money sometimes.
Definitely. Public limited companies, PLCs, can raise huge amounts through share capital. They sell tiny pieces of ownership shares to investors.
And people buy them hoping the company grows and the share price goes up, or they get dividends.
Exactly. And crucially, this is permanent finance. The company doesn't have to pay the money back to shareholders like a loan. The tribal group example shows them using this for expansion. Sometimes existing shareholders get first dibs on new shares too. That's a rights issue.
What if a business is small but has amazing potential, like a tech startup?
That's often where venture capital steps in. Specialist investors, VCs, put in significant cash into businesses they think could grow massively. It's risky, but they take an ownership stake.
Hoping to sell it for a big profit later.
Precisely. High risk, potentially high reward. And a more recent development is crowdfunding.
Getting small amounts from lots of people online.
You got it. People chip in, maybe for small share, maybe for early access to the product, or just to support the idea, like Marine Techno, the biotech firm mentioned.
Wow. Okay, that is a lot of different ways to get money. So the main takeaway here is...
I think it's that there's no single best way. Different sources suit different needs, different business sizes, different stages. A startup's needs are very different from a giant PLC's. Picking the right source, or combination of sources, is a really critical decision for any business owner.
Makes total sense. Okay, so the business gets its finance, it starts operating. Now it starts spending money too. Costs. Let's dive into that.
Right. Running any kind of operation costs money. Paying for materials, staff, premises, everything you need. These are the business's costs. And interestingly, costs don't all behave in the same way.
How do you mean behave?
Well, some costs just
Right.
stay the same, or pretty much the same, regardless of how much stuff the business actually makes or sells. We call these fixed costs.
Like the rent on their shop or factory, you pay the same rent whether you sell 10 things or 10,000.
Exactly that. The source uses Frampton Training as an example. Their rent is US $40,000. Doesn't matter if they train one student or 200. The rent bill is 40 grand. Other examples, insurance premiums, salaries for permanent admin staff, maybe basic advertising costs.
Okay, fixed. They don't change with output, so what's the opposite?
Variable costs. These ones do change, directly in line with how much the business produces or sells. Make more, they go up. Make less, they go down.
Ah, okay. Like the ingredients for a baker. The more cakes they bake, the more flour and sugar they buy.
Perfect example.
Right.
Or the wood, for those cricket bats in the Candasan case. For Frampton Training, their variable cost was US $500 per course. So more courses, proportionally higher variable costs. Packaging, components, maybe wages for production workers, paid per item, those are typical variable costs.
Right. So if you add up all the fixed costs and all the variable costs, that gives you the business's total cost.
Yep, simple as that. Total cost equals fixed costs plus variable costs. Now, on the other side, businesses earn money. That's their revenue, usually calculated as the selling price of each item times the number of items they sell.
And obviously, most businesses want their revenue to be higher than their total cost. They want to make a profit.
That's the usual goal, yes. Profit is what's left over when you subtract total costs from total revenue. If costs are higher than revenue, well, that's a loss.
Okay, this is where it gets really practical, I think. If you know your costs, how do you figure out how much you need to sell just to cover everything, to not make a loss?
That specific point is incredibly important. It's called the break-even point. It's the level of sales where total revenue exactly equals total costs.
So no profit, but no loss either, just breaking even.
Exactly. And there's a handy formula for working it out in terms of units sold.
Go on.
You take your total fixed costs and you divide them by something called the contribution per unit.
Contribution per unit.
Yeah, that's simply the selling price of one unit minus the variable cost of making that one unit. It's how much each sale contributes towards paying off those fixed costs.
Okay, let's use that fire alarm example. Ed Winchester. Fixed costs, US $20,000 a year. Selling price, US $25 per alarm. Variable cost, US $5 per alarm.
Right, so first, find the contribution per unit. That's US $25 minus US $5, which is US $20.
So every alarm sold brings in US $20 towards covering the fixed costs.
Precisely. Now, to find the break-even point in units, divide the total fixed costs, US $20,000, by that contribution per unit, US $20.
US $20,000 divided by US $20, that's 1,000 alarms.
You got it. Ed has to install 1,000 alarms in the year just to cover all his costs. Every single alarm he installs above 1,000 starts generating profit. It gives him a clear target.
You can draw this on a graph too, right? A break-even chart.
Yes, it's a great visual tool. You plot a line for total costs and a line for total revenue. Where they intersect, that's your break-even point.
And it shows more than just the point itself.
It clearly shows the profit or loss at different sales levels. And it shows something called the margin of safety.
Margin of safety.
That's the difference between the current or expected level of sales and the break-even level. It tells you how much sales could drop before you start making a loss. It's a measure of risk.
Okay, so understanding costs and break-even seems fundamental for any business. What's the real value for someone starting out?
I think it's about control and planning. Knowing your costs helps you manage spending, and break-even analysis is just essential planning. It forces you to think, what do I absolutely have to sell just to keep going? It helps set realistic sales targets and understand how changes in price or cost will affect your bottom line.
Yeah, you definitely want to know that before you launch. Okay, businesses have money, they spend money, they hopefully make money. How do they keep track of it all? Their financial health.
Through financial documents. Think of them as official reports, scorecards almost, that tell the story of the business's money, where it came from, where it went, what's left.
Different reports for different jobs.
Exactly. One that's super important for just surviving day to day is the cash flow forecast.
Forecast, so it's looking ahead, predicting.
Yes, that's the key word. It's a prediction, usually month by month, of all the money expected to come into the business, cash inflows, and all the money expected to go out. Cash outflows.
Inflows, like sales money coming in, maybe a loan payment received.
Yeah, customer sales, payments from people who owe you money, new loans, owner investment. Those are inflows. Outflows are all the payments out.
Paying suppliers, wages, rent, buying materials.
Right. Loan repayments, advertising bills, tax payments, anything going out.
And the forecast nets it off each month.
It does. For each month, you calculate the net cash flow that's simply inflows minus outflows. Then you add that net figure to whatever cash you started the month with the opening balance to get your closing cash balance.
And that closing balance becomes the opening balance for the next month.
Exactly. The Sala Motor Services example in the source shows this prediction month by month inflows from petrol and repairs, outflows for wages and stock, and how the cash balance at the end of each month is expected to change.
What's really striking about cash flow is you can be profitable but still go bust, right?
That's the crucial, sometimes painful lesson. Profit is about revenue eventually exceeding costs over a period. But cash flow is about having the actual money in the bank when you need it to pay bills. If customers pay late, or you have huge bills due before your sales cash arrives, you can run out of cash even if you're profitable overall.
So profit is the long game. Cash flow is immediate survival.
That's a great way to put it. The beauty of the forecast is it helps you spot potential cash shortages in advance. If it looks like you'll be short in March, you've got time now to arrange an overdraft, chase debts harder, maybe delay some non-urgent spending. It's a critical survival tool.
Really highlights the difference. Okay, cash flow forecast looks forward. What about looking back at performance? How much profit did we make?
With that, you need the statement of comprehensive income. You probably know it better as the profit and loss account, or P&L.
Okay, P&L. What does that show us?
It summarizes performance over a period, usually a year. It starts with revenue total sales. Then it subtracts the direct costs of making those sales, the cost of sales, to give you gross profit.
Profit just from buying and selling the main goods or services.
Essentially, yes. Then it subtracts all the other running costs, the overheads, like rent, salaries, marketing, to get the operating profit. That's profit from the core business operations.
In there.
Then you account for things like interest paid on loans and finally tax to get the bottom line, the profit for the year, or net profit. The source shows this breakdown for Doha Food Store and Walnut Soaps.
So the P&L tells you if the business model is actually working, if it's profitable.
Exactly. How well did it generate sales and control its costs over that year? Essential reading for managers and investors.
Okay, P&L for performance over time. What about a snapshot? Like, what's the business worth right now?
That's the statement of financial position, which most people call the balance sheet. Think of it like a photograph taken on one specific day, usually the last day of the financial year.
And what does the photo show?
It shows three things: what the business owns, assets, what it owes to others, liabilities, and the owner's stake, capital or equity.
Assets, things with value the business owns.
Correct. Split into non-current assets, long-term, things like buildings, machines, vehicles, and current assets, things likely to turn into cash within a year, like stock, money owed by customers, that's trade receivables, and cash itself. The Dingwall Building Supplies example lists these clearly.
And liabilities are the debts, what it owes.
Yes. Again, split into current liabilities, debts due within a year, like money owed to suppliers, trade payables, short-term loans, tax and non-current liabilities, debts due further down the line, like mortgages or long-term loans. Dingwall shows those too.
Is there a core idea linking these three parts?
Absolutely. The fundamental accounting equation. Assets, liabilities plus capital. Everything the business owns has either been financed by borrowing from others, liabilities, or by the owners putting money in capital. It has to balance.
So the balance sheet shows the structure, the funding, the overall stability at that moment.
Precisely. Now, just looking at these big statements full of numbers, it can be hard to really see the story, right?
Yeah, a list of numbers doesn't always mean much on its own.
That's where ratio analysis comes in. You use formulas to calculate relationships between different numbers on the income statement and balance sheet. It turns the raw data into useful insights.
Comparing numbers to get a better picture, like percentages.
Exactly. For example, the gross profit margin. That's gross profit divided by revenue, shown as a percentage. It tells you, for every pound or dollar of sales, how much is left after paying for the goods themselves. Higher is generally better.
Or the operating profit margin.
Yep. Operating profit divided by revenue is a percentage. That tells you how efficiently the business controls all its operating expenses relative to sales. The Eckholm's example calculates these, showing their profitability.
What about checking if they can pay their bills? That liquidity thing.
Good point. We use liquidity ratios for that. The current ratio compares current assets to current liabilities. The asset test ratio does the same, but excludes stock from current assets because stock might not sell quickly.
Why is that important?
Because, like we said with cash flow, being unable to pay your short-term debts can kill a business, even a profitable one. These ratios give you a quick health check on that ability. The Eckholm's ratios suggest that we're okay, but maybe a bit reliant on selling stock.
So ratios add context and allow comparisons.
Compare your ratios this year to last year, or compare them to a competitor. That's when the numbers really start talking.
Okay, which leads nicely to the last bit. The use of financial documents. Why bother with all this? Who actually looks at these things?
Well, connecting it all up, these documents are vital communication tools. They provide hard quantitative information numbers. That helps lots of different people make much better decisions.
Who uses them? Inside the business first.
Managers, definitely, all the time. To track progress, spot problems like cost creeping up, monitor cash, decide where to invest, justify budgets. It's fundamental for running the business day to day and planning ahead.
And outside the business.
Lots of people. Investors, existing ones and potential new ones, use them to judge profitability, stability, and risk before putting money in. Banks scrutinize them before lending money, assessing the ability to repay.
Suppliers, maybe? Before giving credit?
Good one, yes. Suppliers might check your health before offering generous payment terms. Tax authorities, of course, need them to calculate how much tax is due. Even competitors or journalists might analyze public company accounts.
So they're really not just bits of paper for the filing cabinet. They're active tools for understanding and decision-making.
Absolutely. They tell the financial story of the business in a standardized way. Understanding them is like learning the language of business itself.
Wow. Okay, we have covered a huge amount there, diving into the IGCSE Business Finance Unit.
We really have. From where the money comes from, sources of finance to managing costs and revenue, figuring out that crucial break-even point, and then the key documents like cash flow forecasts, income statements, balance sheets, and how to analyze them with ratios.
And hopefully, you listening can see this isn't just theory. These are the actual tools entrepreneurs and managers use constantly. Learning this stuff is about understanding why some companies thrive and others struggle, how big decisions get made, what makes a business look like a good bet or not.
Definitely. If you're curious about how the world of business and money actually works, how companies operate, and you want skills that are valuable pretty much everywhere, whether you start your own thing or work for someone else, this unit and the whole IGCSE business course gives you a brilliant grounding. It's about understanding the story behind the numbers.
So here's something for you to think about. If you were starting your own little business project, maybe next week, based on everything we've just talked about, which one financial idea or document do you think you'd look at first to help you succeed, and why?
That's a really good question to ponder. Thanks so much for tuning into this deep dive. We really hope this look inside business finance gets you thinking and maybe encourages you to check out the IGCSE Business Eat Excel course in more detail.